In the previous episode, correlation was the hidden driver of diversification. This episode keeps that same variance framework, but asks a harder question. If we can calculate how much risk each asset contributes, why should we allocate by dollars at all? A 60-40 portfolio looks balanced by capital, but when stocks are much more volatile than bonds, most of the actual risk still comes from equities. Risk parity starts from that mismatch. Start with the portfolio variance formula on screen. It says total risk comes from three things: the weight of each asset, the volatility of each asset, and the correlation between them. Once we have that formula, we can ask a precise question. If we add a little more of one asset, how much does total portfolio risk change? That is marginal risk contribution. Multiply marginal risk by the asset's portfolio weight, and we get the asset's total risk contribution. In a clean two-asset example, stocks have 15% volatility, bonds have 5% volatility, and correlation is 0. The stock term becomes 0.0081. The bond term becomes 0.0004. So even though the portfolio is only 60% stocks, stocks contribute about 95% of total risk. Published historical estimates are usually closer to 90% because real covariance data is messier than the clean example. But the conclusion is the same. A traditional 60-40 portfolio is not a balanced risk portfolio. It is mostly an equity risk portfolio with a bond sleeve. The reason is simple. Stocks are roughly 3 times more volatile than bonds. In a 60-40 portfolio, the larger capital allocation is also placed into the more volatile asset. That combination overwhelms the bond position. The Panagora and Chian data make this concrete. From 1976 to 2009, stocks had higher return, but also much higher volatility. Bonds were not useless. In that sample, bonds actually looked efficient per unit of risk. The problem was sizing. The bond position was too small in risk terms to change the portfolio's bad months. Across 32 monthly losses worse than 3%, stocks contributed an average of 97% of the loss attribution. Bonds contributed about 3%. This does not mean bonds failed in 97% of months. It means the portfolio's risk budget was already dominated by equities before the sell-off arrived. Risk parity changes the unit of measurement. Instead of asking how many dollars go into stocks and bonds, it asks how much risk each asset contributes to the whole portfolio. The formal condition is equal risk contribution. Each asset should contribute the same share of total portfolio volatility. In a two-asset stock-bond portfolio, that condition simplifies into inverse volatility weighting. The higher volatility asset gets the smaller capital weight. The lower volatility asset gets the larger capital weight. With stocks at 15% volatility and bonds at 5% volatility, bonds are 1/3 as volatile as stocks. The equal risk solution is therefore about 25% stocks and 75% bonds. Capital is no longer 60-40, but risk becomes close to 50-50. That is the cleanest intuition behind risk parity. There is a trade-off. A 25-75 stock-bond portfolio has more balanced risk, but it usually has a lower expected return than 60-40 because more capital sits in lower-returning bonds. The institutional solution is leverage. Instead of accepting a lower return target, investors scale up the whole risk parity portfolio. That can target a similar volatility level to 60-40 while keeping the risk contributions more balanced. Historical studies from AQR and Panagora found higher Sharpe ratios for levered risk parity in their samples. But leverage is not free. It adds financing cost, margin risk, and implementation complexity. When interest rates are low, the drag can look small. When rates are high, the drag becomes visible. So leverage is both the practical solution and the main implementation risk. Risk parity is not a free lunch. Its weaknesses are real, and they matter most when the macro regime changes. The first weakness is correlation risk. In normal environments, stocks and high-quality bonds often diversify each other. But in some stress periods, both can fall at the same time. Q1 2020 showed a sharp correlation shock. 2022 showed an even clearer problem. Inflation rose, rates rose fast, and both equities and nominal bonds were hit together. The second weakness is financing cost. A levered risk parity portfolio needs borrowed or synthetic exposure. If gross exposure is 1.8 times, then roughly 0.8 times net asset value is financed. At a 5% funding rate, that can be around 4% annual drag before fees and implementation details. The third weakness is assumption risk. Risk parity works best when major asset classes have roughly similar Sharpe ratios over long horizons. Pan-Agora and AQR both lean on that idea. Critics argue that equities may have a structurally higher reward per unit of risk than bonds, especially over very long holding periods. The fourth weakness is regime dependency. Many historical backtests benefited from the long bond bull market from the early 1980s through the 2010s. If inflation stays high, real rates stay high, or stock-bond correlation stays positive, a portfolio that relies heavily on duration can struggle. The balanced view is this. Risk parity is a disciplined framework, not a magic allocation. It diversifies the sources of risk, but it still depends on correlations, financing costs, and the economic regime. Bridgewater's all-weather strategy is the most famous real-world implementation of the risk parity idea. It was launched in 1996, and it expands the logic beyond a simple stock-bond split. The organizing map is macroeconomic. Growth can rise or fall. Inflation can rise or fall. Different assets tend to respond differently in those four environments. Equities and credit prefer growth rising. Long treasuries and nominal bonds prefer inflation falling or growth falling. Commodities and tips help when inflation rises. Gold and other hedges can behave differently again. The simplified goal is not to make one big bet on equities. The goal is to size exposures so that no single macro environment dominates the portfolio. That is risk parity, translated from asset weights into economic regimes. The caveat is sample dependence. Risk parity indices looked strong in some bond-friendly periods, but those results were helped by the macro backdrop. The framework is useful, but the regime still matters. Risk parity answers the question raised by 60-40. If a portfolio is not truly balanced by risk, what would balance actually mean? The answer is equal risk contribution. Measure the risk budget first, then allocate capital. That idea is mathematically clean, and it explains why a smaller stock weight and a larger bond weight can still be more balanced. But every portfolio framework in this series has assumed something deeper. That market prices reflect available information. When you buy or sell, are you trading at a price that already contains what the market knows? That is the next question. Eugene Fama won the Nobel Prize for arguing yes. Robert Shiller won the same Nobel Prize in the same year for arguing no. The debate decides whether diversification, risk parity, and volatility, drag reduction are built on solid ground.